The bull put spread. This is just a brief 1 minute overview of the strategy, and we'll explain the strategy in greater detail as you go through the course. So you're looking at a 1 year chart of SPY. Throughout the year, the shares have traded somewhere between 187 and 213. And the share price at the moment is 203. So you might have the mindset here that you think, okay, SPY is going to stay above a certain level, but I don't think it's going to go up too far. So you're mildly bullish in the position. And this is where the bull put spread comes in. It's a really good strategy for that type of mindset. So what is the bull put spread? Well, it's really just an extended version of the short put strategy. So there's two trades in the bull put spread. The first trade is you sell a put option at a strike price, and we always say go out of the money, so at a strike price which is below the current share price. So let's take this example. Maybe we want to sell the 192 put, and in that particular side of the trade we want the share price to stay above 192, and then we buy a bit of protection underneath that just in case the share price does fall substantially. So we buy the 190 put underneath it, and that's going to cost us money to place that part of the trade, but it won't cost us as much as what we took in at the 192 level. And the result is we receive a credit. That's why it's called a credit spread. So we get paid up front for placing this trade. So as long as the share price trades above 192, we're going to make a full profit on this trade. Now, what is our profit? Well, our profit is limited to the amount of income or premium we've received when we place the trade. And our risk is also limited, and it's limited to the difference between the strikes. So in this case it was $2 minus whatever premium we take in. So this is what we call a defined risk and a defined reward strategy, and it's a high probability strategy, because if you think about it, the share price will have to fall nearly $13 or nearly $11 here before you start losing money in this particular transaction. So it's a high probability trade.